Hi, I'm Jacob Mitchell, CIO of Antipodes Partners.
And I'm Andrew Findlay. I'm Managing Director of Antipodes, as well as being a Director of Antipodes Global Investment Company, ASX APL for short. Jacob, it's been a challenging time for value managers such as Antipodes over the last 12 months. What's been going on in the market?
Well, if you think about the parts of the market that are performing well, you've got crowding into sort of quality growth stocks, and these stocks are now on fairly extreme multiples. At the same time, more cyclical businesses have become very cheap, and arguably are pricing in sort of recessionary type environment. From a region perspective, North America continues to outperform with the benefit of sort of fiscal stimulus, although that's starting to fade. And then from a sector perspective, growth has really been expressed in sort of the internet and software part of the market. And it's been tough for Antipodes just keeping up in that environment. We're underweight the US, especially the domestic part of the US. Whilst we do have exposure to software and internet, we're generally in the more, let's call it the safer, less racier expressions. And arguably we've been in an environment of sort of, let's call it softening growth expectations. We have been guilty of being a little too cyclical too early, although we could make a case that those stocks, we don't own them because they're cyclicals and they're on low multiples. We own them because they're great businesses and they will grow even in a very fairly tough economic environment.
And Jacob, what sort of market conditions would you expect the portfolio to perform best?
We are clearly underweight domestic US. So when we talk about domestic US, we're talking about we're not talking about the large consumer staples, the large healthcare stocks, or the technology stocks. We're talking more about the financials, the property related, the stocks or the sectors that are going to be more vulnerable to just the domestic economic environment. So we think as to the extent that domestic growth in the US starts to fade and potentially in response to fiscal stimulus in other parts of the world, it starts to accelerate, led by Chinese policy. We think some of that underperformance gap can start to close in Antipodes' favour. Secondly, in an environment where investors become more discerning around what is the right multiple to pay for growth, Antipodes should do okay. We think some of the more extreme expressions of disruption are actually relatively weak business models, and at the moment the market is willing to pay any price, any PE, or in many cases some of these high-flying software internet names don't have earnings, and they're on very high multiples of revenue, and the market is effectively funding their growth. If the market becomes more discerning around that, we would expect to see potentially more of a rotation, out of growth into more value parts of the market. Not value for value's sake, but looking for companies that are, let's call it, unfairly penalised because of their perceived cyclicality. If we choose wisely, we'll find companies that can grow. So PE dispersion is very high. So I think that favours being more selective. And then I think thirdly, it's an environment where the only show in town has been US dollar denominated assets. And if we are in an environment where US growth starts to normalise versus the rest of the world, appetite for US dollars will also start to reverse. And we think the current account surplus regions, which are Asian and European, can have a reasonable domestic cycle, and their currencies can potentially also outperform the US dollar. Andrew, what are we doing to close the APL discount to NTA?
Most equity LICs and global equity LICs in particular are trading at reasonably significant discounts currently. APL has been caught in that same industry trend. In terms of what we're doing to address the discount to NTA for APL, first and foremost, it's all about investment performance, which we've already discussed today. It's the only sustainable way to address a discount. From the company level, the board is very focused on addressing the discount, and we've taken a number of measures, increasing our communication with shareholders, our transparency, simplified our reporting, and doing everything possible to create a very shareholder-friendly way of operating the company. And finally, it's important for us to demonstrate alignment with shareholders. As we've announced recently to the market, Antipodes as manager, various individuals and associates of Antipodes have all been buying shares in APL to the tune of around about $6 million so far this year. We hope APL shareholders and potential shareholders have found this video session informative as we try to step up our visibility and communication with you. For any feedback, please reach out to us. You can also contact us or find out more information about APL at antipodespartners.com. Thanks for listening.